Hey everyone, it's Tom. Today I'm going to tell you the key things you need to know before taking out a loan. There are some fundamental concepts that everyone should be aware of about amortized loans because they greatly impact how much you pay back on a mortgage, a car loan, student loans, among others. I recently made a video on the best time to buy a home, and based on some feedback I received on that video, it suggested that a video on the fundamentals of amortized loan interest might be helpful. So first, let's start out with the word amortized, which simply means that the loan is paid back in full over the course of time through a series of payments, usually monthly payments. It's a derivative of the word amortire, which referred to killing off the loan or the debt in this case. Most amortized loans, like mortgages, are paid back monthly. They're paid back in monthly installment payments. So in order to figure out how much interest you pay each month, you take the monthly interest rate times the outstanding balance on the loan. And then to figure out how much you're paying toward the principal each month, you simply subtract that amount from your monthly payment. And then you repeat that month over month, every single month for the duration of the term of the loan to figure out the amortization schedule. And because of the fact that most lenders quote interest rates as an annual percentage rate, in order to figure out the monthly interest rate, you just simply divide that annual percentage rate by 12. There are a number of factors that determine the interest rate you might pay, but the interest rate is related to the amount of risk that the lender is taking on for a given outstanding balance, which is why the interest you pay each month is the product of your outstanding balance times the interest rate. But what's not as transparent about the amortization schedule is how you arrive at the monthly payment amount in the first place. It's the exact amount of money required to pay off the loan in full over the term of the loan, given the fact that every single month you're going to be paying a certain amount of interest, which is equal to that outstanding balance each month times your interest rate. So for now, we'll just take for granted that the formula for the monthly payment is given here, where N is the total number of months in the term, or the total number of periods in the term. So for a 30-year mortgage, for example, this would be 360. But since it's not intuitively obvious how to arrive at that formula, I'll make another video on that since it's really nothing mysterious. If we're going to take an example, let's say we're talking about a 30-year fixed rate mortgage with a 6% interest rate, and you're taking out a loan of $400,000. So the monthly payment would be computed as this. And if you wanted to figure out how much interest you'd have to pay in the first month, it would be $400,000 times the 6% annual percentage rate divided by 12, or $2,000. Now, if we plot this amortization over the term of the loan, you can see that the breakdown of the constituent interests and principal payments follows a curve. And many people have probably seen a graph like this and might be tempted to ask, why don't lenders just simply take the total interest and the total principal and divide them evenly so that you repay the same amount toward both each month? That would look like this. The problem with that is that it doesn't represent a fixed rate. The amount of interest you pay each month wouldn't be in constant proportion to the outstanding balance. And what that means to the lender is that they would be receiving a lower interest rate for a higher risk, which would be the case at the beginning of the repayment period where you still owe $400,000. And at the end of the repayment period, they would be receiving a higher interest rate for a lower risk, which would be the case for the last monthly payment where you'd only owe $1,111. And that just doesn't make sense. The amount of interest paid should be in proportion to the amount of risk that the lender is taking on for the given outstanding balance. So if you're repaying a loan with a fixed monthly payment, the fact that you pay more at the beginning of the term of the loan in interest is simply a function of the fact that the balance is higher at the beginning of the term of the loan, and the amount of interest you pay each month is in constant proportion to the outstanding balance, with whatever's left over going toward the principal, because again, it's a fixed monthly payment. So now that we've covered that, another key thing to understand about amortized loans is how the interest rate affects the total amount of interest that you'll pay over the course of the term of the loan, and your monthly payment. In this plot, you can see the comparison of a 3% and 6% annual percentage rate on a 30-year term loan of $400,000. Though this is representative of a mortgage, the same trends apply to loans of shorter terms like car loans. The blue dashed line represents the principal payments on a loan at 3% APR, while the red dashed line represents the interest payments. And the green solid line represents the principal payments on a loan at 6%, while the magenta line represents the interest payments. You can see that the point where the sets of lines cross is where the interest payments become lower than the amount applied toward the principal. The principal overtakes the interest on a loan at 3% APR after 7 years, but for a loan at 6% APR, it doesn't occur until about 18.5 years into the term. Also, the total interest paid doesn't scale proportionally with the annual percentage rate. The total interest paid is the area under each of the magenta and the red curves. And the area under the magenta curve, which is for an APR of 6%, is about 2.25 times greater than the area under the red curve for an APR of 3%. In fact, if we plot the monthly payment and the total interest paid over the 30-year term against the annual interest rate, we can see that those trends are not linear. So, for example, for this $400,000 loan over 30 years, if the APR was a fixed 6% instead of a fixed 3%, which is a 2x factor, the total amount paid would be 42% more. But if the APR was 8% versus 4%, which is still a 2x factor, the total amount paid would be about 54% more. And if you compare the total amount paid on a loan at 18% APR versus 9%, it's about 87% more. So what you need to know is that for high interest rate loans, you're paying a disproportionately greater total amount of interest. And because of that non-linear relationship, paying off high interest rate loans early will actually save you more money in the long run than you might even think. With that said, thanks everyone for watching. I hope you found this helpful. If you did, please hit the like button and subscribe down below. And please let me know in the comments if there are any other videos you'd like to see. Until next time,